Investment arbitration, some people say, is an instrument of a grand bargain, the promise of capital flow in exchange for a promise to protect foreign capital flow now and in the future. No, some people will say. Investment arbitration really is an instrument that allows private investors to dominate the economic, if not political, affairs of underdeveloped nations. And so investment arbitration is a vehicle for domination that followed in the wake of foreign invasion and occupation. In fact, no, investment arbitration is an instrument that promotes democratic accountability and participation, good and orderly state administration, and the protection of rights and other deserving interests. I can hear the interjection, no, that's not it. What investment arbitration really is an instrument that imposes a neoliberal rule of law that promises predictability and certainty at the expense of democratic politics. Well, these are very different views of what investment arbitration is and does. These different views are all pushed very seriously by different, very serious authors. The proponents of these views are obviously convinced that they are right. But how can we really know? Where can we find credible arguments that prove that these views find or do not find echo in reality? Well, what I tried was to look at 562 investment arbitration cases, and I coded certain aspects of these cases. That is, I created a database containing information about relevant aspects of these cases so as to bring out their salient features. Concretely, what I did was, for instance, and that's the information I'm going to use for this talk, to look at the polity score of the host state, the polity score of the investor's home state, the level of economic development of these two states according to the World Bank classification based on gross national income per capita. That's the classification in high income states, upper middle income states, middle income states. That's a category that disappeared over the years. Lower middle income states and low income states. These factors were related to the outcome of the case, namely whether the investor won the case or the host state won the case or if the case settled. By winning, I mean in favor of whom the initial award was rendered. The cases that were included in the study are all cases on which we could find information. That includes exit cases, UNCITRAL ad hoc cases, PCA cases, NAFTA cases, SCC cases, that's the Stockholm Chamber of Commerce, ICC cases, and a few others. That's how I came to 562 cases. All the findings were related to the year in which the cases were filed. The time span of the study covered the years 1972, that's when the first exit case was filed, until last year, May, the month of May exactly. So the purpose of all of this was to try to get a better understanding of what the geopolitical functions of investment arbitration are and how these functions have evolved over time. Okay, let me try to explain what I mean by geopolitical functions. This man, David Caron, a professor at Berkeley and the current president of ASIL, has a theory about the functions of international courts and tribunals, which he presented in a paper delivered in Geneva in June of last year. He considers that tribunals have a direct function and a consequential function. The direct function of international courts and tribunals, including investment arbitral tribunals is to resolve the disputes before them. Easy enough. The consequential function is, in essence, in David Caron's words, adjudication's general value for society, that is, the general broader value of the tribunal in question for society. For instance, when it comes to commercial tribunals, one consequential function could be to make contracts enforceable, which in turn sustains or promotes the certainty of contracts, which in turn furthers the international trade of goods and services. Okay, now let us apply that to investment arbitration and revisit in greater detail what I've said at the outset of my talk. In the literature on investment arbitration, we can distinguish 5 consequential functions that investment arbitration supposedly fulfills. We can bring them under only 3 headings, which is why we have this numbering here. The first and perhaps most obvious is that investment arbitration serves to attract foreign capital to developing countries. The idea is simply that investment arbitration, as an institution part of the broader international investment protection regime, leads to an increase in the flow of foreign investments from rich northern countries to southern developing countries. This in turn is meant to stimulate the economic development of these so-called southern countries. This was in fact the initial purpose of the creation of ICSID in the mind of Aaron Broches. In sum, this was to be a fairly conventional World Bank project seeking to help developing countries get capital to develop their economies. Remember the idea of a promise of capital flow that we have seen earlier. A number of economists have studied the correlations between a country's participation in the international investment protection regime, for instance by being member of ICSID and thus participating in investment arbitration, and the progression of capital inflows. For every study that found a correlation, in other words, for every study that found that investment arbitration is useful to attract investments, there's another, or rather 1.5 studies that found that there is no correlation, that investment arbitration is useless in this regard. So I'll put this aside. The second view of the consequential functions that investment arbitration fulfills may be called the bold post-colonialist view. According to this view, what investment arbitration really does is help Western European and North American countries regulate what happens in developing countries. The whole system of investment arbitration, it is said, is a vector of the exploitation of southern countries by northern countries. Remember the idea of a domination of developing nations. Okay, third view. De facto post-colonialism. This is essentially a softer or more indirect version of post-colonialism. The argument here is built in 2 stages. First, proponents of de facto post-colonialism maintain that the investment arbitration system seeks primarily, if not exclusively, to maximize the protection of the investors. Accordingly, the entire system would be skewed in favor of investor protection, and the ultimate object of investment arbitration is to assign to investment interests the highest possible protection. Then the second stage of the argument of de facto post-colonialism is this. The proponents of this view assume that investors in the system are from the north and invest in the south. The fourth view of the consequential function of investment arbitration is that investment arbitration promotes domestic rule of law. It is there to replace domestic courts in unreliable countries. Remember, democratic accountability and participation, good and orderly state administration, protection of rights. The idea here is really that investment arbitration is there to improve the regulatory quality of the host state by bringing it to firmer adherence to the rule of law, which is achieved by replacing its dysfunctional domestic courts by investment arbitration. So the target of the system is rogue, non-rule of law, non-democratic states with governments that take erratic decisions because courts there are unreliable. Now, the fifth view of what the real function of investment arbitration is supposed to be may be called the pursuance of the international rule of law. Here, investment arbitration is there to promote the international rule of law. The rule of law is understood here as guideposts for self-directed action. So the purpose of investment arbitration is to help make clear for all investors and all states, regardless of the type of investor and state. So no reference is made here to unreliable or undemocratic states. The purpose is to make it clear for them what their rights and obligations are regarding on investments. Okay, so now we have them here again. Okay, that's the theory about the consequential functions of investment arbitration. Now, what have I found? Well, before I tell you, I should show you this. The evolution since 1972 of the number of investment arbitrations filed each year. Note that the sharp decline at the very end is simply due to the fact that I stopped counting in May of last year. And meanwhile, many cases have been filed, but that's not really what matters. What does matter is this year. The system, so to speak, changed gears in the mid-90s. That's when it really took off. But again, what have I found? I first looked at the polity score of the host states. The polity score is essentially a proxy for the level of democratic development of a state, to which we can associate the strength of the rule of law in that state, though I confess there's no absolute causal relationship here. So I looked at the polity score because if view 3a is correct, if investment arbitration is really there to replace the economic courts of non-rule of law countries, then we would expect that an important part of the cases are filed against the governments of host states that have a low polity score. What my data show is this. This chart shows the average polity score of host states for each year since 1972. What we see here is that until the mid-90s, their average polity score of host states was indeed rather low, but that this has changed radically in the mid-1990s. Today, the average polity score of host states is high, which suggests that the system is not used primarily against non-democratic, non-rule of law states, and therefore we can legitimately have doubts about the validity of the view according to which the function of investment arbitration is to replace the domestic courts of non-rule of law countries. I had already taken out the first view of the consequential function of investment arbitration, as economists seem unable to agree whether participation in the investment arbitration system contributes to an increase in foreign capital flow. Now, I think we can take out the view we just discussed. Then I looked at who sues whom. The reason for looking at this aspect of the cases, is that if it is correct to say that investment arbitration is an instrument of post-colonialism, then the cases should predominantly be investors from post-colonialist countries suing post-colonial countries, which means investors from northern countries suing governments of southern countries. That is, investors from high-income and upper-middle-income countries suing governments from low-income and lower-middle-income countries. So I first looked at who files the claims, and I found this. The chart shows the economic development of the investor's home state. In red, the cases filed by an investor from a high-income state. In black, from an upper-middle-income state. In gray, almost invisible in gray, from middle-income states. In dark blue, from lower middle-income states, and in light blue, from low-income states. So the investors filing investment arbitrations are almost systematically from so-called rich states. Investment arbitration seems indeed to be there to protect the economic interests of rich states. So the theory of post-colonialism seems correct so far. Then I looked at the economic development of the host states. In light blue, the cases that were filed against a government of a low-income country. In dark blue, the cases that were filed against lower middle-income countries. In gray, that's relatively irrelevant, middle-income countries. In black, upper middle-income countries. And in red, cases that were filed against governments of high-income countries. Now, what seems striking is that roughly 50% of the cases were brought against rich northern countries. This may lead us to ask, are the colonialists suing one another? Well, we can be a bit more precise and look at these roughly 50%, and that's the pairs of claimants and respondents. That's more strictly speaking the who's whom that I promised. And here's what we see. In black, the, so to speak, proper post-colonialist cases, where an investor from a rich country sues a government from a poor country. In red, the cases where an investor from a rich country sues a government from a rich country. We can see a radical change in the late 1990s. Since 1997, there are more north-north cases than north-south cases. Most cases nowadays do indeed take place among the so-called colonialists. So I think we can have doubts about the post-colonialist view, at least since the mid-1990s. Now we may ask, does this mean that there is a revolt of so-called former colonies against former colonialists? Meaning, are investors from developing countries suing developed host states? Well, here's the answer. No. In black, again, the cases where an investor from a rich country has sued a government of a poor host state. In red, the reverse. An investor from a poor country suing the government of a rich host state. So we can clearly say that investors from developing countries have not taken up the sword of investment arbitration against developed host states. Which means that if we look specifically at investment arbitration from a north-south perspective, then it seems clear that it remains very much a one-way street. Then I looked at who actually wins the cases, because if we nevertheless stick to the de facto post-colonialist view, which means you will recall that investment arbitration is there to maximize investor protection, that therefore the system is skewed in favor of investor protection, then if we adhere to that view, we may ask, is investment arbitration really a powerful sword in the hands of investors with which they can do what they want? Because if it is so, and if the system effectively works, then investors should rather massively be winning the cases. Well, do they? Investors do win more often, more than states, but not massively. The chart on the left shows the winning rates of investors, the chart on the right, the winning rate of host states. But now, effectively, if the investor gets only a small fraction of its claim, say less than 25%, of its claim, should we not count such an outcome as a victory, as a win for the host state? Now, if we do, we get this. The winning rate of host states is often above 50%, in particular since the late 1990s, with a sharp drop, though, in the last 2 years. So the de facto post-colonialist view, which would follow the motto that the higher the protection of the investor, the better, leaves us, or at least it leaves me, with doubts. And these doubts, in fact, are reinforced if we look at the settlement rates, at how many investment arbitration cases have settled. That's what this chart here shows. We can see that up to above 40% in the late 1990s and early 2000s, up to above 40% of the cases then settled. So if we now pool together the winning rates of the states and the investors and the settlement rates, we see this. The wins of the investors are in red, the wins of the states are in gray, and in black the cases that settled. So on the whole, we can not say that investors strongly dominate. So it appears that the view that survives empirical verification is the view according to which the function of investment arbitration is to promote the international rule of law. It is to make it increasingly clear for investors and host states what they can and cannot do about an investment, regardless of the economic development of the relevant states or their level of democratic development and adherence to the rule of law. The fact that there's an important and in fact dominating share of North-North arbitrations, and that all in all there are balanced shares of wins for host states and investors and of settlements. The system overall seems rather well balanced. Now I should acknowledge that what I just said has limitations on two fronts. The first issue is that, as a rule, host states only win in defense, so to speak, and host states usually don't get anything from the investor. So the system is still asymmetric. The response to that argument is provided by Jose Alvarez, who says that the inherent asymmetry of the system is there, he says, to compensate investors for their exposure to the host states as a contracting party, regulator, sovereign, and judge. The asymmetry is nothing but the reverse mirror image of the investor's exposure to the host state's regulatory power. The second limitation of the view I just presented about winning rates is this time raised by José Alvarez. He states that a win record of whatever percent for investors tells us nothing whether objectively investors deserved to win these cases or only have as many. Fair enough, but the problem with Alvarez's argument is these two elements. Objectively deserved to win. How could we as analysts really know that investors, or host states for that matter, objectively deserved to win a case? It would of course be an ideal study to go through each case and assess whether one of the parties would objectively have deserved to win. But that seems to me to be rather impossible to do without knowing the particulars of the case, including the exact facts of the case. So it seems that the best people to carry out an investigation of the underlying functions pursued by arbitral tribunals, the best people to do that are the members of these tribunals themselves. So we end, of course, with a circular argument, and beyond acknowledging that we should take studies based on winning rates with a grain of salt, I don't think there is much we can do. Such studies, I think, are still better than simple wild guesses. Now, one last thing we should say about the system is that it seems to favor the haves or the have-nots. If we compare these four charts, which show the winning rates of host states based on their level of economic development, that is, how many cases a high-income state, for instance, wins out of all the cases filed against it in a given year. High-income states, upper left corner, then on its right, upper middle income states, and then the so-called southern states in the bottom two graphs. If we look at these charts, it seems clear that high income states and upper middle income states win their cases more often than lower middle income states and low income states. A high income state stands higher chances to successfully defend itself than low income host states. This means that the economic power disparities remain a significant factor of success. Rich states come out the winner of the system. So a bit of a flavor of post-colonialism does remain. So I come to my conclusion, which moves in three parts. Our prescriptive views of the functions of investment arbitration, that is, what we think the functions of investment arbitration ought to be, can legitimately be based on morality, economic theory, or political philosophy. But that holds true only for prescriptive views. If we want to make descriptive statements about the functions of investment arbitration, that is, what consequential functions investment arbitration pursues in fact, then these statements should be based not on morality, economic theory, or political philosophy. But that, unfortunately, is what we have mostly in the literature, at least in the legal literature on investment arbitration. Such descriptive statements should be based on empirical analyses. And of these, we should have many more. I should perhaps point out that the last significant empirical academic study was conducted by Susan Frank in 2006. She covered 82 cases. I should also mention UNCTAD's database, which has approximately 400 claims, but UNCTAD does not provide any analysis of the trends. It is only a database, a compilation of the cases, so to speak. Now, my second conclusion: descriptive statements about the functions of investment arbitration should be time sensitive, by which I mean that they should refer to specific periods of time. We have seen that investment arbitration seems to have been a very different creature before the mid-1990s than what it has become since. And more refined studies than mine would undoubtedly show one or several further evolutions since the mid-1990s. My third observation in conclusion starts with a question. Is investment arbitration successful in promoting the international rule of law? Here again, a quote by José Alvarez may help. He writes that the investment regime is far from promoting the rule of law and democratic governance. It threatens both by creating legal enclaves available only to those who need it the least, while producing inconsistent rulings that do not satisfy its own constituents' needs for predictability. What stands out here is clearly in contradiction with the rule of law. What stands out here is, of course, this: the system's inconsistency and lack of predictability. So my contention is that investment arbitration is still a far cry from a satisfactory legal institution, but it seems to indeed be pursuing the right end, that is, the promotion of the international rule of law. It simply doesn't do its job very well.